right, good morning, everyone. Welcome to the Trade Buyings and Adjustments, which we are really going to call a commentary this week. But we are going to give you our 4 big plays or our 4 opportunities that we see for, let's just say the opportunity that we see for big money to be made this year on a couple stocks. So we're going to give our 4 picks for where we see big money coming up this year on some stock plays. We're just trying to make a call on what we think can happen. With that said, you guys are currently looking at the My Hurley investment. If you ever miss one of the commentaries, the Hurley Investments market commentaries, or you miss the trade findings and adjustments, this is where you're going to find those opportunities. This is where you're going to be able to pick up, and if you can see the leap long calls, the one that Keith did last week, this is where you'll be able to hear those videos, get an opportunity to listen to what we gave to you, and just have a chance to review what we said in the past with all of our notes. It goes back to some 2008, so there's a big opportunity here for you to see past history, and we'll go from there. All right, let's get our Word document up. It was actually about a week and a half ago on the 10th. I went over valuations and what I'm looking at. As I went through those, I just went to FinViz, picked up some very simple chart patterns, went through some very simple fundamental analysis using current price, forward PE, next year's earnings per share, and the expected price that that they should fit into that range. Here were the stocks that we came up with. Here's what we were looking for. And some were good, some were bad. It was funny. I kind of said, yeah, Ford's basically done. Ford tanked. We would not be in Dollar General. There were just some things that we looked at that told us where we'd be looking for an opportunity here or there. So with that said, our first one that we'd be looking at for next year is none other than Best Buy. And if we take a look at the price of Best Buy, Best Buy is currently right now today $130. So we're looking at a price of $100.30. Now, as we went through Best Buy's numbers, the first thing we were looking at was not that one, not that one. First thing we were looking at was its previous price. And its previous high comes up here, right here, intraday. And we're looking at right around 142.13. So first thought off of what we're looking at fundamentally, previous high price, how much does Best Buy have to run higher? There you go. Yeah, back up to 142. So I'd be looking at it, roughly $42 on a $100 stock with roughly $42 to the upside, right? We're looking at roughly a 42% gain. It's that simple. Well, Kevin, why would you choose Best Buy? What makes you think Best Buy is an opportunity? Because it's a pretty flat chart all last year, right? pretty flat chart, kind of moved at the end. Kevin, wasn't that a Christmas rally? Wasn't it moving higher? This is the ultimate reopening trade for us. When we're looking at this, it is the ultimate reopening trade. Hey, we're seeing that things are going to keep moving higher. We're going to see that people have been in their homes for a year. It is just the ultimate reopening trade that people are going to go buy new TVs, new radios, new sound systems, new computers, new laptops, more gizmos for virtual training, the meta universe. It's just, it seems to make sense after what we've gone through for the last 2 years with COVID. Let's work our numbers. Forward PE, it has a forward PE of $10.74. What I really should do is just kind of shorten this down a little bit. There we go. So we have a forward PE of $10. Excuse me, of 1074, excuse me. Actually, as we went through it, we actually found out that most hardware or retail stores, and we could probably see it up here for like CVS, was a 14 through 16 or a 14 through 18. So for, it's a little higher. A 14 through 18 is where we would give the PE. The earnings per share, pretty simple. It was $9.25. And we're looking for that 142 previous high, right? So first of all, as we were looking at Best Buy, 14 times $9.25 puts us right at the 129.50. And if we go to the 18, the high side, times $9.25, I'm sorry, it should have been 16. I said 18, it should have been 16. We're matching CVS. 16 times $9.25 puts us right at that 148 range. And the high falls in there at 142. So people were asking, Best Buy, really, Kevin? What are you thinking? It's a reopening trade, and there was some unique opportunities on Best Buy that we felt it at least should be at that 130 range to 142, which makes this for us a no-brainer or an opportunity for next year. What are your thoughts on Best Buy? Can you guys see that? Doesn't make sense to you? Again, we worked our numbers and we saw the big fall, and the big fall was really because of some supply constraints. Supply constraints loosening up into next year should also just help out Best Buy. There we go. I get it. All right, you guys get that one. Perfect. Okay, if I was looking at my second and third ones, it is also reopening trade, and it has to do with travel. So who do you think I could be talking about? Our next trade has to do with travel. Our next opportunities has to do with travel. And James Bosserman just came in. Glad to have you. Jim, I should say Jim Bosserman, or just Bosserman just came in. We finally got your account over to Schwab. It only took 6 weeks, but Jim, your stuff has moved over and we have access to it again. Glad you're here today. All right, so interesting. 4 of you just came up with United Airlines and Alaska, or not Alaska. Was it Alaska? American Airlines, excuse me. So you guys think the airlines, which is not a bad thought, but let me just show you a little bit of what I'm noticing when it comes to airlines. One of the reasons we're not necessarily looking at airlines is because it seems like it should be a great reopening trade, and it has easy numbers to beat in the next year. It seems to be more regulated. I think we're going to have higher fuel prices. I'm not sold on airlines. So if I was looking at airlines, I'd go, one of the reasons why is because, let me find a couple of these. I thought I saw them last week. There we go. American Airlines. This was one that I was looking at, paying attention. They surprised and beat by 6 pennies because they were expected to lose $1.48. They only lost $1.42. A year ago, it was $3.86. They're going on a 2-year slide. Well, Kevin, they're down a lot. It seems like it could be an opportunity. It could be. I just don't see it. I personally just don't see it. And then I think we had United Airlines that also reported. Where is United Airlines? I'm going to take a quick look here. American Airlines was there. There it is, United Airlines. United Airlines surprised to the upside by 49 cents. But they lost $1.60. They were supposed to lose $2.09. A year ago, they were losing $7. Their revenue, both, this one actual revenue is $8 billion versus $7.9 billion. American was $9 billion. They just don't look good. And part of it, I wonder, is if people are afraid to fly. If they haven't bought into hey, they've got filters, it's just circulated air, and the American public is thinking, you know what? It's a virus. It goes through masks. It's going to go through a filter. People just don't seem to be buying the airline safety right now. So, no, believe it or not, I'm not looking at airlines. I'm looking at something that's probably even worse and more contagious. So my next two are Royal Caribbean as well as Carnival Cruise Lines. And this would be a reopening trade that I would be looking at, where I'd be looking at a new opportunity. Let's start off with Royal Caribbean. That would be my top one. Royal Caribbean Cruise Lines. And you're going to notice the forward PEs are absolutely messed up. There's no way that we're going to get a PE of 255. Their earnings per next year is 32 cents. So at least we have something positive, right? I can't work PEs to show you where I'm at. What I'm really looking at, because return on assets all ugly, what I'm really looking at is the short float. 1% normally can move a stock 15%. When we're looking at 5.88, we have a huge, huge short float on Royal Caribbean Cruise Lines. The question is, where can they get to, right? Where can they get to? How far can they move higher? Will people be willing to travel on a cruise line versus an airline? I know you're like, Kevin, you just put down the airlines. That's every reason people aren't going to go on a cruise line. I get it. I understand. But there seems to be a difference. There seems to be a, hey, you know what? People seem to be more interested on a cruise where they can get off. And for that reason, if I was looking at Royal Caribbean Cruise Lines, I would be looking at an opportunity to get back to previous highs that again are at 133.99. Let's just say 134. So an $83, 83 and just getting over the 200-day simple moving average shows me, hey, there seems to be a lot of upside potential. So as I went through Royal Caribbean Cruise Lines, currently it's trading at 83.97, and the PE ratios are not making sense. So because the PE ratios are not making sense, I am looking at a short float, which would be a covering or a short squeeze rally of 5.8% and a previous high of 133.99. Those would be our reasons as we're looking at breakout stocks. Those would be the reasons that we'd be looking for that upside opportunity in our areas. Also, long-term debt equity doesn't look good. Nothing looks good on Royal Caribbean Cruise Lines. But if we're looking for 4 breakout opportunities, it starts out with Best Buy, Royal Caribbean Cruise Lines, and then we have number 3, Carnival Cruise Lines. With number 3, I would still think Carnival Cruise Lines will look much like Royal Caribbean. Come on. So Royal Caribbean Cruise Lines, $21.84, right? Looks absolutely awful. Kevin, that's what we're looking for, right? Yes. Forward P is 11.24. Earnings are at 1.89. That's how you get up to your 24. Again, short float rate at 8.43%. So just working numbers, if you have a 15% upside, right? Roughly a 15% short squeeze upside, for every 1% or for 1%, man, if I do 8 times 15%, it's like 120% rally to the upside just on the short float alone. So does that make sense, right? Typically 1% induces, and it's a range, it's probably something like 12 to 15% upside opportunity. But yes, huge short float, and it shows at least 120% upside short float squeeze opportunity. Bill made the comment, long-term debt and debt to equity doesn't look good. They never do in this category. Anybody know why their debt to equity, debt to long-term debt to equity ratios would look bad? Think real estate. The real estate also does the same thing. Sometimes retail will look bad for the same reason. But why are we somewhat ignoring the long-term debt? What do those 3 categories, retail, real estate, obviously the cruise lines, what do they all have in common that makes us overlook some debt to equity ratios? Expenses to get going, kind of. That's along the same line, but I'm thinking, well, I'm thinking a little bit something different. There we go. So cost of the boats, that's what I was thinking. I was thinking, well, it's got to cost a couple billion to build these big cruise line boats, right? The good news, that billion is a depreciating asset, and they should probably, or they should be at least writing it down. But I would think that, hey, it's a depreciating asset, and it's a huge expense to build one of these huge cruise line boats. So that's just where I would be in my head looking at it. $21.84. And again, the PEs don't matter. A short float rate of 8.43% and a previous high of, let's find out what the previous high is. I'm just looking over the last 2.5 years. 51.34-ish. So here we have those opportunities. It actually looks like Carnival Cruise Lines has a better upside opportunity than Royal Caribbean. All right, and so pretty interesting. Anyone take a guess? What do you think my number 4 forward opportunity could be for stocks that we're looking at and stocks that we did our research on? Tesla. Not doing Tesla. And I know, William, you'll say, blah, 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 what am I trying to say? I'm going to beat you to it. There you go. You've got it. Netflix. Netflix, we're not doing Netflix either. Netflix reports, what, today, right? Netflix has earnings today. No idea? All right, well, it actually was General Motors. But right now, Ford looks to be a quicker and better return than General Motors. For any of you that may have not been paying attention, this was yesterday. Why was Ford down yesterday? It's about Rivian and accounting, and a little complicated and kind of silly. Ford made $900 billion gain on the IPO of, and I know I'm not saying it right, but Rivian. But they're going to recategorize that gain not as income, but as a one-time payment, which means they're going to cash out of it. They're not going to run it higher. It's going to be a one-time payment. So yesterday the stock lost 7.5%, and today it was down another 3%, but it finally got back higher. The reality is they're not losing that money. And some people think, oh, they called between a 10.5 and 11.5 billion dollar earnings this year. Oh, they're going to lessen it by $900 million. Well, the revenue is still there. It won't be categorized as revenue, but is still a long-term capital gain for Ford. That money doesn't disappear. It was an investment that made them a crap ton of money. but because it's not going to be categorized as income, or obviously, nor should it ever have been related to the sales of their trucks or their cars, it's a finance issue. Right now would be a great time to buy back into Ford. Some of you, we got out on over half your shares up at 27. You may see us go back into Ford from the run up right now. It was trading at around $22.50. If I take a look on my phone, Ford right now is trading at $22.74. Nope, it's down 14 cents. I'm sorry. It's trading at $22.31 right now. This is an opportunity for Ford. The numbers are still their numbers. And they're probably going to announce on their earnings report on February 3rd, hey, we still captured $900 million. The money is still there for us to use as we see fit. We're just categorizing it instead of income as a long-term capital gains investment, which it should have been categorized the whole time. I like it because I've got another one in here about Bill Ford doubling down on Ford shares. 16 million Ford shares, Class B, and 4 million Class A. Bill Ford has been amassing huge amounts of Ford. He believes in his company. He believes in the turnaround. It's always nice to see someone in management. I think he's just on the board, though. Nope. Yep, he's just on the board. It's really good to see family members as well as the CEO start to hold on to their own stock. I was going to go through today how General Motors has big opportunity. I would go to Ford. Ford has a 20 to 25% upside, back up to 27.50, right from where it's at right now, only because people don't understand accounting. Should they have put it differently? Of course they should have, but the numbers are still the same. They're not losing $900 million. It's just being categorized as a long-term capital gains investment. It still could be capitalized as income, but it's not income on the sale of their cars. And that's where someone went through and they looked at it and they said, oh, they're going to make $10.5 to $11.5 billion on their cars. No, that is the guidance for earnings for the company going forward. That is a mixture of investment, sale of the cars, the financing arm that they have in division. It is a company-wide earnings forecast for next year. But some people don't ever look through Schedule Ks. They assume it's just for the sale of their cars. It really is pretty silly. But welcome to people not understanding what they think they understand. How's that to put some analysts and some people and throw them under the bus there? All right, here we go. Let's take a quick peek. Where will our markets end this week? We need to get some charts in here. Dow Jones Industrial Average. Let's do an update. And let's shrink it down to only 6 months. It's obviously going to be bearish. We've had a pretty much of a butt kicking coming up into this year. I really need to put the pop-ups and block the pop-ups on some of these websites. I will get to that shortly. Dow Jones Industrial Average, if we take a quick peek at it, we are bearish. We are bouncing off the 200. So we're getting a rebound day. Definitely a bearish looking chart. Below the 50, hit the 200, bouncing higher. Lot of uncertainty going into earnings season right now. A great opportunity to have protective puts on to be protected for the uncertainties. All right, SPX, same looking chart, but we are in between the 50-day and the 200. Bouncing off of 45.50 or the lows of December, the highs of September, the lows of December is what I'm trying to say here. The S&P is also bearish. And then if we look at the Nasdaq, looking at the Nasdaq composite, we're going to see a breaking of the 200-day, and the Nasdaq has lost more than 10%, or it is in a bearish trend right now. It would say correction territory. We are in correction territory on the Nasdaq. So if I was to put these all in here, insert these pictures, we're getting the simple, what I say, the simple, hey, we should know better, but our markets are in bearish territory. And we are going through just a little bit of a pullback or a correction. 35 down to 37 down to 35. You know, there's a 5 to 6.5% return or pullback there. We have 4,800 down to 4,500. There's about a 7 to 7.5 pullback on the S&P, and we are over 10%. So we are in correction territory, not a bear market territory. Bear market's down 20% or more, but from the highs of 16 to 12 to 14, we are down over 10% on the Nasdaq, which means it's going to be hard treading uphill and up water against the indexes. That will be difficult to do. We won't look to see a good run through earnings because you're fighting the indexes. Earnings this week, Royal SP in January, I'm still saying it's going to be down 3%. We were down about, 2.25% at the end of last week with more this week. So we are to the downside, probably already hit or we are close to, I'm going to take a quick check here, 3% down for the year. We are up 1.29% today. And actually, year to date, we are down 3.8% on the S&P 500. So this might have been a pretty good call for January. A little bit of profit taking, a little bit of people taking profits now. It won't really help them if they're tax issues. But yes, I do find it interesting. And William, great point. So let me go ahead and, since we're talking about risk to the market, anyone know what one of our market risks, or just in general? In general, we have a new market risk that Biden actually spoke about yesterday. Had a press conference on it. Anyone catch what our new market risk is? Midday yesterday, Biden had a press conference on it. And I'm saying in general because it's been a market risk last year, but now it's really becoming a market risk. William, you typed it in, so that's why I'm not saying it. We've got 14 other people here that maybe know. There you go, Mary. You were paying attention. Russia and Putin invading Ukraine. There it is. We had Biden come on yesterday, talk that Russians amassing, and that he's talked to Putin and actually said, "Hey, we're going to put the screws to you. Your economy, your oil, your gas. You're not going to be able to sell it." Russia basically was saying, "Hey, well, if we don't invade, we'll do it on two conditions: that Ukraine doesn't enter NATO, and that Ukraine isn't used as a staging spot for weapons against Russia." To, of course, Biden, when his cronies were saying, "Oh, hey, he should have said, we got no answer on if Ukraine joins Ukraine. It's a voting, and there are probably a couple decades away from being available to do that." But yeah, there's real fears that Russia can invade Ukraine, and actually to the point that Biden had a press conference on it yesterday. If you didn't see it, go look that up on YouTube. It was pretty interesting. All right, let me keep going through so I can open up for questions for you guys. Earnings, second week of bank earnings. They're all across the board. Schwab and Goldman Sachs were not too good. U.S. Bancorp, I don't remember if it was good or not. Morgan Stanley was good. Alcoa reported yesterday. Discover Financial Services reported yesterday. Bank of America reported yesterday, and they looked good. We are looking at taking off those long puts relatively quickly on Bank of America, since we do have some profit in them. Key Corp today, Netflix today. That'll be a big one after the market closes. First Horizon National, American Airlines, Schlumberger on Friday. Economic reports, pretty interesting. The Empire Manufacturing was supposed to be at a 25.0, came in at a negative 0.7. That was most likely why we saw the down Tuesday. Yesterday, building permits came in higher, 1873 versus 1702. Housing starts came in higher at 1702 versus 1650. Huge increase, almost 10% on building permits and housing starts. Good news for yesterday. And then today, Philly Fed came in at 23.2 versus 20, helped ease the fears on the Empire New York. And let's face it, New York as a state sucks, absolutely sucks at taking care of their companies that work there, the taxes. It's really a very poorly run state. Of course, Philadelphia is going to look a lot better than New York. Existing home sales came in a little bit lower, 6.18 versus 6.42. And again, we were in line for initial and continuing claims. Leading indicators tomorrow is rather big. It'll be a 0.8. It'll run our futures for tomorrow. See if we continue the rally into today. I have a couple interesting articles. Why it's forward down today for yesterday. Another hedge fund manager says ARK ETFs are a waiting time bomb. Just going over what I went over with you guys on Kathy Woods and what she invests in. Bill, pretty interesting. 28 millionaire. Here's how to earn $1 million. And they're just a couple interesting things I just throw out here. I found the article interesting. Wage inflation is arriving in a big way, and Damien Diamond says CEOs shouldn't be crybabies about it. I love the article. I put it out here for you guys to read. And last but not least, the professor predicted the Great Recession, shares 3 trends that will dominate work in 2022. Have this in here for you guys to read. And I actually put a parenting expert shares 5 toxic mistakes that can make kids more selfish and entitled. I find myself talking about this more and more. So I just have it in here for you guys I have it in here for me, let's face it. It's something for me. Saying yes to almost everything, kind of hard. Little girls wrap you around their finger. Failing to create teaching opportunities. I find myself making that mistake a bunch of times, just telling them instead of teaching them. Not addressing what's happening in the world. I think I do a pretty good job there. Giving them everything without enforcing gratitude. I really think I do a good job on 4. And number 5, I really do it to them pretty good. Not reducing them to volunteer work. Pretty amazing on some of the things that we do here and that I'm doing with my kids. With that said, what questions do you guys have for me? I know we're starting a new year. We missed a little bit with the holiday. Are there any questions you guys would like me to answer that maybe you haven't been able to ask in the last week and a half, 2 weeks? And of course, yeah. So how is the transfer coming? How is the transfers coming? So we have laggards, and the laggards are basically, for me, it still is about 15% of my business that that needs to come over, which about 6.5. Well, it's less than that. I guess it's about 5.6 million. Someone made the comment, will we be using Schwab or the Street Smart Edge? And the short answer is yes, as soon as my accounts come over. So kind of weird. There's a 7-day holding period for business accounts, and apparently it sounds like it's a 30-day period for moving licensed broker dealer information over. Never really heard of that. Again, I'm really new to their platform, trying to shorten that learning cycle on how to use it. So still focusing on the next 2 weeks on getting people's money over. Poor Jim Bosserman. It was just a trust account for him, held up for 6 weeks. E-Trade side holding things up, which I really didn't understand. Stuart, your corporate account also took 6 weeks, and it's kind of a pisser because we get locked out of them. There's nothing we can do. They're in transit is the term, which means they're locked out, and there's not a whole lot that we can do by way of trading as we think that we should. But the short answer is we still like what we're in. We still figure that we're going to be in good shape. And actually a question just came in. When do you think all the accounts will be over? I'm hoping by the end of January, all accounts will be over. And has it forced me to change my strategy? No, if anything, it's reinforced. I'm glad that we had protection on some of those positions during that time period. Unfortunately, what it means is that we sold out of some positions as those long puts put those stocks away to other people to higher price. So it's now my opportunity to buy back in at a lower price, and I have to do that 31 days after if it was done for a loss, but everything was pretty much sold for a profit. So the short answer, no, not changing the strategy. The strategy works and actually helped protect some of our positions through this transition period and transition time. Any other questions you guys have? Great questions by both of you, by the way. Thank you. If not, I've basically run an hour. I am busier than the devil today, so I'm going to call it today. Appreciate having you guys with me. Appreciate having you guys back. Oh, and with that said, the guy for my coins should finally be done the end of January. So here I was trying to get this done. COVID shut down. Well, I shut down the guy I used to use because he did a pretty poor job on the last couple batches of coins. Went to a new guy out in California that, boy, I wish he'd moved back out here to Utah, but He's doing my coins. Coins have not come to me yet. I am about a month late on your holiday, Christmas, season's greeting, coin mailers out. I do apologize, but your Christmas, New Year's cards / coins are on their way. The coin should be here by the end of January, so the first week of February, I'll get everything out. and someone just said, and here I thought you were pissed at us. And William, you're kind of new, so that's not fair to say, but William just texted in cheap ass. That I was being a cheap ass this year. Ouch, William, that hurts. All right, guys. All right, hey, have a wonderful day. Pleasure being back. I will see you Monday, and Monday I will be out in Vegas area, traveling next week, traveling the week after. But I will see you next Monday. We'll be in Vegas. We'll have our commentary on normal on Monday evening. Keeve should be taking care of the trade findings and adjustments on Thursday. And then the following week, I'll be in Houston. Dad has a pretty good appointment for his cancer. So boys are kind of getting together. We'll have 2 days there, Wednesday, Thursday, the beginning of February, that we're trying to see how Dad's doing and if he can do any better. Guys, take care. Wonderful having you. Look forward to seeing you next Monday. Take care, everyone. Have a good one. Bye-bye.